Welcome to the daily update, where I'll go over the action in the market for Friday, December 13th, and we'll see how things look for Monday, December 16th, kind of dealing with the same situation that we have been all week. We have some of our indicators that are positive, and we see that large caps and growth are holding up. Semiconductors had a pretty good day, and that's helping the market. But we're still seeing under the surface weakness within the S&P and across the broader market. Now, with some of our indicators, we're getting to an extreme negative reading, which when we're in a more uptrend environment like we have been for the last couple of years, we watch those a lot more closely because we tend to not go extreme negative for very long. Now we'll have to see if there's more weakness that comes into the market that could shift everything over to a more negative side. But we're still well above the 20 period moving average. We really haven't tested the short-term trend, at least yet. We're also finishing up on some negative seasonality on a short-term basis, and about the middle of December or so is when we start to shift over into more positive seasonality. Now, we don't know if it's going to play out like that or not, but historically, that is the general scenario that we deal with. And so far, even though we've deviated a lot from seasonal norms over the past few months, especially the end of the summer and into the fall, we're kind of going back more in step with those seasonal tendencies. So we're just seeing some under the surface strength for right now, but we're also seeing some weakness at the same time, and that's giving us a mixed picture. Okay, there's a thing called the SPX Investing Program. It's up, it's going, it's free until the end of 2024. Feel free to check that out. I'll be locking it down at the beginning of 2025. There are additional videos that I post there, and you're more than welcome to check it out and see what you think. If you have any questions, you can send me an email. There's a link that will take you to the website or to a video that talks more about the program, and you get immediate access to the videos as they are available. Also, the daily video is the real foundation of the analysis that I do. Now that we're hitting the weekend, I'll be doing the outside videos, but all of those are meant to tie into the daily video. All right, let's go back and talk about what happened and then look at some charts. We had a higher open and prices climbed above R1 at 60.70, but we hit resistance slightly below the 60.70 level, and that was the high for the day. So we saw the open look more optimistic, and then as the day unfolded, things turned more negative. We then declined back down below R1. We got down below the daily pivot at 60.61. We even went below the unchanged level, and that took us negative. And we found support at S1 at the 60.42 level, right around that point. Then we chopped between the unchanged level and a little bit below S1, but then this is rather encouraging. We saw some late day strength coming back in. We were headed to having quite a not a real negative day, but it was going to be more negative. But then we saw some buying coming back into the close that pretty much we were down just a little bit, but on a percentage basis, we were unchanged. So, yeah, it goes in the books as a down day, but on a percentage basis, we were unchanged on the day there. We were below average with volume, and we are still looking positive in the short, intermediate, and long term. But we're seeing some internal weakness, and we're seeing a real lethargic market right now. We had mostly down days this week. We had a nice upward move on Wednesday, but then we just went right back to Thursday declining. And then Friday was like a big treadmill. And of course, there's all the geopolitical things. And it was a week ago that things really developed in Syria. What's it going to be this weekend? And is the market even going to pay attention to that? So far, it has not had much of an impact. Some comments. It was a mixed session. Some indexes were up, some were down, and small caps ended up underperforming. And interest rates are going back up, and this is pressuring stocks right now. When interest rates are going up, that can really drag things and really show that the buying it sometimes either stops and stalls out, like we saw on Friday, and then actually leads to selling. But the semiconductors were up. Excuse me, the semiconductors were up 3.4%. We still have this non-confirmed Hindenburg omen. That's going to go through until December 19th, so Thursday of this upcoming week. If we don't see another spike, then that's going to fall off the radar. On a short-term basis, we're still looking extreme positive with the stochastics, even though they're all coming down right now. And we have an oversold condition. This is what I'm talking about. When we're in a solid uptrend, which we have been, we really watch these a lot closely when we see opposite types of signals. And we're getting extreme negative with the Stoch RSI. Intermediate term, we still have the Sean trend meter that has been extreme now for quite a while, but that's also showing that the more intermediate term momentum is hanging in there. And we're coming down a little bit, but we're still right at the border of being extreme positive with the NASDAQ 100 bullish percent index. And that's what we're watching right now. It's been the NASDAQ 100. They hit all-time highs. And the NASDAQ closed over 20,000 for the first time during the week. And so that part of the market is holding up fairly well, but we're not seeing it really driving the indexes higher right now. And we also have some extreme negative readings like the S&P McClellan oscillator. This was starting to flash warning signs last week, the previous week, and was throwing up some signals saying, okay, don't stay real bullish on things because this was actually going down as the S&P was going up. And we're also getting pretty extreme with the PMO studies, and I'll show you all the charts for these. And really no change to the scenario. It's pretty much and check out the weekly video this where I go through the probabilities. It's looking almost certain, nothing is ever completely certain, that the Fed is going to cut rates in their upcoming meeting this week. And the dollar was up, interest rates were up. Both of these together were putting some pressure on stocks, and we're going back up kind of big here. We were at 4.4% with the 10-year yield, where after Thursday we were at 4.32%. And we're uninverted with both the yield curves now. So now if it can stay this way, we begin the countdown right around 6 months or so to see, are we going to in fact go into a recession? If we go back to being inverted again, it kind of stops that whole thing and we have to start over once it goes back. But we've been inverted with the 10 to the 3 month for about 2.5 years. And the 10 to the 2 year is already back to being uninverted or going back to normal. So now we have both of these together. So we'll just keep looking at the recession charts that I follow, and I post those videos on the website. And as I've been saying, you can make a case for either side. Of course, there's a lot of debate going back and forth. Are we going to go into a recession? Are we not? We'll just keep watching the data and then go from there. Sentiment is still neutral. We ticked up one notch where we had been at 49. We're right at 50. So that's the tipping point according to this indicator. We fall under 50, that's more negative. We go above 50, that's more positive. And we're still positive with our trend. The green line's on top, but it's coming down, and the red line's coming up. But we're right on top of that moving average. And with the choppiness that we've seen this week, it's not really showing any strengthening of the trend. So we're right on the moving average, but we are still in a trending environment because we're above 20. And for right now, I've changed our bias to mixed because we had an unchanged day virtually. And the momentum, I'm keeping it mixed while the market tries to figure out, does it want to break to the upside, or is this weakness going to come through and more selling to the downside? So the economic reports that came out, and I don't have charts for these because they're not real impactful as far as how they influence the market. We had the rundown of import and export prices, where export prices were unchanged. Last time they were up 1%. You take out agriculture, they were up 0.1%, or last time they were up 0.8%. Import prices up 0.1%, the same as last time. You take out oil, they were unchanged, where it was up 0.2% last time. So no charts to show there. But there are some charts from Isabel Net, the blog that they have. This is from Real Investment Advice. And this chart seems to pop up every once in a while just to show the earnings growth trend. It's still intact. They have a couple, like a trend line going on here. And it shows that earnings are, in fact, growing based on estimates. And the dashed line, this is the trend line. And that's what you want to see. That's why the stock market keeps going up, is it's ultimately a matter of coming down to earnings. Then this is 2025, the year ahead, better first half, worse second half. Who knows? But somebody came up with a chart just saying, okay, we're going to do real well. We'll probably get up to 7,000 according to this chart from Bloomberg. We'll get to 7,000 halfway through the year. Then we're going to have a really difficult fall. And then we're going to bounce back by the end of the year to 6,600. I mean, people love these forecasts. I don't forecast myself. I just analyze things on a day by day basis. I use a lot of charts and I come to what I call the consensus approach. It's like, what's the weight of the evidence telling us now? Because people could say whatever they want, but even the so-called experts are wrong, probably more than they're right. And then back to back 20%, 2021 through 2024, cumulative returns trail precedents. So other times when we've had really strong movement, at least from 2023 into 2024, it still shows us trailing that a little bit, even though we're up quite a bit, especially since the October 2022 lows. And this is kind of like a seasonal thing, but I decided not to put it in the seasonal section of the video. This is 1 year, 4 year, and 10 year cycles, and then taking a composite of that, putting them all together, and saying, okay, this might be how things play out in 2025, which of course is different than the previous chart that we saw. So, I mean, people can come up with whatever they want, but we just follow the evidence as it unfolds. And then the rolling 9 week flows into equity ETFs and mutual funds, a lot of money still going in here. And time to buy stocks, really? Well, this is a ratio of when we go above this dashed line, that means the NASDAQ is more attractive. And this breaks down the spread of the NASDAQ 100 earnings yield. You know, they don't really give you dividends as far as when you're dealing with growth stocks because they want to put that money back into the company and grow even more. People would rather have capital gains than dividends coming out of there. But then this ratio compares it to the 10-year treasury yield, where that is something that you want to bring in income. And it's still below this dashed line, saying that if you're looking for generating income either through dividends or interest, you probably better go over to the bond market. You're not really going to get that from the NASDAQ. But that's historically what has happened. And then this is something we've been keeping an eye on. This is the spread between risky and not as risky bonds. And when this really goes up, that means the bond market's really freaking out. They're concerned about something. Well, we've been getting very, very low readings for quite some time now, meaning there's not a lot of fear anticipated in the market. And that's good that there's not a lot of fear out there, but these really low readings, we tend to bottom out at this point. Are we going to turn and go back up? But I've been watching this chart, and I have some charts that I show in the weekly video where it's like we've been seeing this for quite a while, and it really hasn't had much of an impact. But we'll keep watching it because at some point, this will probably come into play and be something that we want to be aware of. Then tech giants have dominated stocks in 2024. No big surprise there. This is the equal weight minus the cap weighted index. And so it's just showing how the rest of the market has been underperforming the big stocks. And not a real surprise with this either. This is the move index. And again, I go over this in the weekly video where the VIX measures the volatility of stocks, the move index measures the volatility of bonds. And this has really been dropping down lately. Okay, I didn't really spend any time on Twitter. I do the weekend videos and I want to spend my time preparing that instead. So here is the intraday chart. It looked like, okay, we were going to have at least a positive open here, but that didn't last for very long. We gapped up a little bit. We got above R1 and we kind of hit resistance at yesterday's daily pivot here, right about at the 60-80 level. And that was the high right there. Then we came down, fell below the daily pivot. We fell down below the unchanged level, tried to find some support right around this S1 level, even fell below that a little bit. Never made it down to S2. But this is the encouraging part that we can kind of take away. We did see some buying later in the day coming in. Now, it didn't lead to a lot of follow through, and it kind of happened halfway through the day, and we didn't see it really go into the close. But this is a little bit encouraging just to see some buying that came in. And then we ended up closing pretty much unchanged, but slightly negative. and not really a big change as we shut things down for the weekend here. But we were coming back with the futures. That's the pink area that you see. And that carried over into the pre-market session as Europe opened. And then things just kind of fell down after that. This is encouraging, and it's been encouraging, and it's continuing to be encouraging, meaning that this could be just a pullback that we're seeing right now, where we see the blue line going up for the most part. It's not really screaming up here, but we're really seeing the red line, which is value, going down. And this is a 10-minute intraday chart of growth versus value. And then this is another thing that's holding up pretty well, right? Since the end of November, we've been going up with the S&P growth to value ratio. And even though the market's been under pressure this past week and not really moving all that much, this has still been holding up fairly well, and that's more positive. So we were up with growth in Friday's session where value was down. We were down more with mid cap growth and down more with small cap growth. So those areas took a bit of a hit, but we're still looking pretty good here when we compare small cap growth to value on the end of day chart. This just generated a recent golden cross with this ratio, and that's looking pretty good there. But you see the index, it's really trailing off. And we actually fell below some support that had been giving us some encouragement that I'll show later. Also trailing off with the mid caps. But when you look at the mid cap growth to value ratio, this has been holding up, even though it ticked down a bit on Friday. And this has been holding up too. S&P growth to value, the end of day, we're in an uptrend here. And this suggests that under the surface of the market, there could be some strength that's building. And this is looking good, even though it came down when we compare a growth versus value ETF. But this has been quite strong. It came back to the previous high that we set last summer. And this has also been holding up, discretionary to staples. Even though it came down overall, it's been really performing well with discretionary outperforming staples. Where discretionary has been going up, staples have also been going up, but really choppy and slightly declining on Friday. Large cap growth just coming off of setting a recent all-time high here. So that this is the stronger area of the market and continues to be that way, at least for right now. This is the trend, and this is getting a little discouraging here. We could be dropping below the moving average, but we're pretty much right on top of it. We are positive since the green line's on top, but we're coming down with the green line as the red line's coming up. We're going to need to see some real buying coming in the upcoming week to turn this back and make it look more positive and have the trend look like it's stronger. And short term, also coming down with the ADX, but the moving average is also coming down. So you could say we're a little bit below that right now, but we are still positive in the short term with the green line on top, but it's declining as well as the red line's been coming up. And volume did drop again to below average. Sentiment pretty much flat here with the VIX, with the line chart as well as the bar chart, but we're getting much lower readings right now. And we're coming down a little bit here with the VIX of the VIX. And it declined on the bar chart as well as the line chart, which is just the closing value. But the momentum of the VIX is now shifting to up as measured by the MACD. We've seen enough of an upward move here to have the momentum starting to go up. And that could be negative. And we're already getting kind of low readings here. So if we do start to go up with the S&P, this is going to drop into a complacent area. And you see, when the market's really doing well, we tend to get very low readings on the VIX, meaning that there's not a lot of complacency, or there is a lot of complacency and not a lot of fear, but it doesn't give this much room to go anywhere. And this is also looking at the VIX seasonally, where we're kind of going through a more upward period right now, but overall, we tend to decline as stocks go up. The skew index is still up in this red area, saying that the market is anticipating some kind of a big move. And this is a variation of the VIX that apparently whatever has happened so far is not enough to bring this skew index down out of the red area. So there still could be something big on the way. And we went up with this fear gauge and we declined a little bit with this other fear gauge. So we're getting a bit of a mixed picture there. And this is the risk on versus risk off ratio. We have been going up overall. And these are the mega caps and the large caps that are outperforming. And we've been chopping around for quite a bit here, but now we're starting to break to the upside as the large caps have been holding up better. We declined with the daily chart of the equity put call ratio, but we're still going up with the 5-day chart. Here's a longer look at the 5-day chart just to give you some perspective. When we get to a really low reading, that can often be negative, meaning that we're topping out in the market. But this could still drop. Notice back in 2021 here, we got much lower readings with this chart. And we're still going up just a little bit here with the 10-day chart. So on the 5-day and 10-day, that's a little more negative. It's picking up some of the weakness that we've seen over the last week or so. And we did see an increase here with the volatility risk premium. We're still above this band, meaning that there's an increase in fear looking out 30 days. All right, the advanced decline line, even though we were virtually unchanged, we're still declining based on price and volume. And this is under the surface, not really showing a lot of strength inside of the S&P right now. And we're also showing a contraction of the new highs, an expansion of the new lows. So we're going down with the 5-day and the 10-day moving averages here. And this is another internal measure that's not showing a lot of strength right now. And we're below the moving average with accumulation distribution. So this is turning a little bit more negative. And we're below the midpoint here with our short-term and intermediate term 19 and 39-day advanced decline ratio. That's more negative too. And this is a further breakdown of the 19-day advanced decline ratio. We're below zero and declining based on price and volume. And we're going down here, even though we saw a bit of a tick up with the histogram, the 5-day line is still going down. And this is another smart money indicator, the Chaikin money flow. And we're continuing to decline with our third smart money indicator, the Chaikin oscillator. And the vortex is still positive since the green line's above the red line, but the green line's really coming down as the red line's been coming up. This is also positive, but showing some weakness. So we look at the cumulative advanced decline line for the S&P coming down based on price and volume. Not a real surprise there. And we're going down kind of more or less sideways here with the S&P, but we're really going down when we look at the NYSE advanced decline line. This suggests that the broader market is seeing more weakness than the S&P currently. So the cumulative advanced decline line for the NYSE dropping below the moving average, also dropping below the moving average with our regular NYSE advanced decline line and this other NYSE advanced decline line, suggesting broader market weakness. Coming down with the common stock on the NYSE based on price and volume. And this is showing a little more weakness too. We're dropping below the moving averages on our advanced decline line studies with the NYSE common stock, S&P, mid caps, and small caps. All the indexes here are dropping below their moving averages. And we're continuing to decline and below 50. So this is negative when it drops below 50, and it's even more negative when it's declining with those stocks inside the S&P that are above their 20-period moving averages. The 50-period moving average is now crossed over negative since it dropped below 50. We're declining but still positive with the 100, also declining but positive with the 200-day moving average studies. Short term, kind of just chopping along here. It was a week ago that the S&P set a new all-time high, and it had a good run intraday, but not on a closing basis. And we were below average with volume in Friday's session. We're dropping with the 20, 50, and 200 period moving average study on the S&P. We're extreme already here with the Stochk RSI. And this is the one that we want to watch. When we're really going up and then we get an extreme negative reading, sometimes this doesn't last for very long if we switch back and look more positive. We're declining, but still above the midpoint with the Williams percent R, the CCI 14, and the CCI 20. So they're showing some weakness on a shorter term basis, but not an extreme reading at this point. And the stochastics in the short term coming down after being extreme positive, also no longer extreme, but declining in the intermediate term, below the moving average and declining, but still extreme positive in the long term. And this is a further subdivision of the short term time frame. Short term, intermediate short term, and long short term. Still positive, but declining here with the force index. Dropping below the blue line and the green line here with I use this to look at the condition of our 20-period moving average and the short-term trend where we're continuing to be below these lines and they're flattening out, but they haven't turned down yet. The longer we stay down below this and actually see more declines, the more these lines may roll over. If we can get back above them, that will turn these lines back up. We're still above the simple and exponential moving averages based on 20 periods, though. So the short-term trend is still intact and it's positive. And we're right at the border between the +1 and +2 channel with our standard deviations chart. So not extreme at this point and still leaning more positive. We're declining and getting close to the midpoint here with the balance of power, but we're still just barely positive there. And then the condition of the 50 period moving average, our intermediate term trend, we're still just a little bit below the red line and the blue line, but we haven't seen these lines roll over at least yet. We're still positive with the go, no go with the darker blue bars, still above the midpoint with the highest high value chart. Still looking a little more negative here with the TTM squeeze. When it turns to the darker shade of blue, that is more negative. And the ease of movement, declining but still above the midpoint. That's still positive. And declining but still positive here with the Erin indicator. We're getting extreme negative now with the S&P McClellan oscillator. We've dropped below this -60 level, and sometimes that can mean a bottom in the market, but it may not be done going down yet. So we're continuing to decline with the summation index based on price and volume. And this was starting to develop, not this week that just finished, but in the previous week, and was starting to give us some warning signs. And we're declining, but not extreme with the NYSE McClellan oscillator. So we're going down with the summation index based on price and volume for the NYSE. Also continuing to decline, but slowing a bit with the Swenlin trading oscillator. This was another indicator that was warning us, okay, be cautious about things. And it was going down as the S&P was still going up. And so that kind of gave us a good heads up there. But this isn't a perfect indicator. There's no such thing as a perfect indicator. Sometimes this leads us in the wrong direction, but it seems to have really told us something this time. But this chart is still negative. We're starting to see momentum taking a hit. We're dropping further below the moving average with the PMO. We've already been declining and in danger of going below the midpoint when we break it out based on price. We're also declining based on volume, but we're still above the midpoint. And we're starting to get extreme with the PMOs that are rising. We've been coming down there. The buy signals are also going down, and we're decreasing with the PMOs that are above zero. And the slope oscillator, which had been looking a little more positive, is now starting to roll over again. The MACD is already negative. It's crossed below its moving average and is declining. So we're seeing some weakness now here. The slope, which it kind of was going the opposite way of price. It was going down as the S&P was going up. Then it was going up as the S&P has been going sideways. So, but it's rolling over now, where the TSI or other short-term oscillator, it's actually looking a little more negative. We're dropping below the moving average with the MACD. We're right on the moving average with the PMO, a little bit below the moving average with the PPO, rolling over, but still looking positive here with the tricks, and right on the moving average still with the KST, our longer-term momentum oscillators. And we're starting to cross back over negative with the copy curve after it had turned positive. And this is the Sean trend meter. We've just been kind of hanging out mostly in this green area, meaning that the things are still holding up, but we're a little bit extreme with this reading. And we're declining, but still above 50 with the money flow, where we've dropped below the midpoint with the ultimate oscillator. And these two charts, the money flow and the ultimate oscillator, I count those as secondary indicators. On balance volume, another secondary indicator. It's declining, but still above the moving average, and the moving average is still going up. And the RSI, more intermediate term based on 14 periods, we're still above 50. We're also still above 50 in the short term based on 9 periods. We're still above the plotted moving averages here. So this looks positive, but we're neutral with the Elder's Impulse system for the S&P, and we're negative with the parabolic SAR. This is the fourth trading day that has the dots on top. We're still declining with the bullish percent index. This is one of those internal measures, again, that is showing some weakness that's giving us some concern. And we're also declining with the NYSE bullish percent index. We came down a little bit, but we're still extreme positive with the NASDAQ 100 bullish percent index. So this part of the market, the mega caps, the real big companies, they're still holding up right now. And I showed this yesterday, and I want to show it again today. This is a support chart, really, but it's also a trending chart. I'm not showing this really for the support because we're far away from this cloud, but we are dropping below the blue line, and this is shorter term. But the blue line's still above the red line, which is positive, and we're kind of chopping around after the green line had been going up. So for the most part, this chart is still positive, but showing a little bit of vulnerability. And we're up at the upper end of this trend channel going back to 2009. We're wondering if that's providing some kind of overhead resistance. And we're more negative now, and you can see even with the Heiken Ashi, a lot of really small candles here, but now it's black, so that's more negative. We're still positive with the Kiki chart, but now we're pointing down. But when you look at the Renko chart, we're positive there, but we're negative with the three-line break. So even our trending charts are giving us mixed signals right now. Then long term, we are coming down a bit here with the 150 and 200 period moving averages. Not a real concern, but they had been above this 350 level for most of 2024, and now we're seeing those come down slightly. And no real changes here. We're still negative in the short term with the mid caps and the small caps. All the other indexes on all time frames are still positive. No changes here. We're negative with bonds based on price in the short and intermediate term, where we're negative with commodities in the intermediate and long term, but they've switched to positive short term. And we had tech, discretionary, and utilities that were up. With tech and discretionary, those are growth areas. And to have them up, that's encouraging. But all the other sectors ended up being down, with communication, another growth area, being down the most. And we're seeing kind of the Christmas tree look here, where we had the BPI crossing below 70 with utilities. And that, since that's going down, that's negative. This is when the NASDAQ got above 20,000, but then it ended up going down below 19.9. The Dow ended up falling below 44,000 after it had gone above 44,000, with the NASDAQ setting an intraday high, and the euro bounced up a little bit against the dollar. And so this is where we're seeing a little bit of a disconnect. We've been chopping more or less sideways here with the S&P, but we're going down with the equal weighted version of the S&P. And so that's causing our ratio to go up, meaning that the large caps are really outperforming. And the Dow, a little bit below this pivot point here. We had settled right at this pivot point after Thursday. We were hoping this level would hold after Friday, but we're just a little bit below it now. And we're still negative with the Elder's Impulse system. We're looking at the diamonds. And after setting a new intraday high, we were virtually unchanged, but up slightly with the NASDAQ and the NASDAQ 100, which was up 0.75%. This was a better performing area of the market. And we're going from neutral back over to positive with the QQQs, with the Elder's Impulse system. The momentum for the NASDAQ 100 is still positive. Small caps, I pointed this out that we came down to this pivot point and we're holding above it. No, we ended up dropping down below it in Friday's session. So you can see we really shoot up and then just kind of trail off here. It's kind of like you send a rocket up into the air and then the parachute comes out and it just drifts down. That's kind of what's been happening. This is the Russell 2000 small cap index, which we're dropping further below 50 with the RSI, and the momentum is negative. And we're still negative with the Elder's Impulse system when looking at the small caps. We also dropped below this pivot point with the mid caps. The hope was that this support level may hold. Well, it didn't in Friday's session. And we're negative with the mid caps with the Elder's Impulse system. Still holding up okay here. We were down slightly with the Wilshire 5000, also down 0.1% with the total US stock ETF. And the financial sector has really been one of the stronger areas and well above its 50-day moving average, but we've been seeing more weakness as we're coming back down to the 50-day moving average. The FANG index set an all-time high, and these are the mega caps, the really big stocks. And so we're getting a little above the short-term trend line, and that's encouraging. If we can stay above that and then bring the rest of the market along with it, that will turn things more positive. Apple was up 0.07%, just barely up, where Amazon was down 0.2%. Microsoft was up or down 0.5%. Meta was down 1.66%. Google was down 1.11%. And see, this is draining on the indexes here. Nvidia was down 2.25% and dropping below its 50-day moving average, where Tesla was up 4.34%. And this is what's really been driving the discretionary area lately. Tesla's really been doing well these days. And Netflix, a little bit off of setting its recent all-time high. And we're really watching the semiconductors. And as I've been trying to point out, this is just looking at the SOX index. When you do that and you put a 50 and 200-day moving average on the prices here, we're below that and we're having a hard time getting back above it. Now that's negative. And we also do a ratio between the semiconductors and the tech sector. And this has really been underperforming. But in Friday's session, we really came up since semiconductors had a good day. We need to see more than just one day. We need to see this overall trend start to change and go back up like it was earlier in 2024. But then when you look at the SMH semiconductor ETF, we're still above the 200-day moving average and coming back up to the 50-day moving average. So this support level is still holding. And this is another look at SMH where we're coming up into the top end of the rainbow. If this could really start to go back up, that will really help the market. And seeing a little bit of a drop off when we compare US with world stocks on a short-term basis, but the longer-term correlation is still improving. Oil was up 1.81%, getting back up into the 70 range, even with all these geopolitical things going on. And the dollar is in an uptrend and was up slightly in Friday's session. And we're going back up now with the 10-year yield. When yields were coming down, that was helping stocks go higher. Now we're seeing interest rates going back up, and that's pressuring stocks. And so we're coming down based on price. And I wanted to bring this up. I'll also go over this in the weekend videos, but we're looking at home construction and a ratio of the 3 to 7 year bond where we've been above the rainbow. Well, now we're coming down. We're getting close to this 250 period moving average with this ratio. Now, we came down here last summer and we were able to bounce up off of that. We're getting close here. We're wondering, are we going to be able to bounce up off of this? Or if we fall through there, this moving average, that could turn things more negative. But we're still looking good when we compare the Qs or the NASDAQ 100 to the 3 to 7 year bond ratio. This is setting a new all-time high here. So that's looking pretty solid. And we're going back to being uninverted now or regular with the 10 to the 3 month yield curve. We'll be watching that to see if it can stay that way. Our growth to value ratios, this is another positive thing under the surface. They're still looking good when we look at the Qs to S&P, discretionary to S&P, and large cap growth versus large cap value. So the large caps, mid caps, and small caps, they're hanging in there. And this could be under the surface and really give the market some strength if we can get back into a more positive environment. So what's our outlook for Monday? We're still positive and we're coming back into a time of positive seasonality, but we still see this weakness under the surface. We're going to get the New York Fed Empire State Manufacturing in Monday's session and the S&P Global US Manufacturing and Services PMIs. We'll just keep an eye on those to see how that's behaving these days, and then the whole list of geopolitical things to see if the market even pays attention to that. Here's the upcoming economic calendar where we're going to get retail sales on Tuesday as well as industrial production and capacity utilization. Then on Wednesday, that's when the Fed is going to make their announcement. And the anticipation is that they're going to cut rates 25 basis points. But then there's their statement, there's that little book that they come out with, and then there's the press conference after that. So the market will be hanging on all of those things to see how it wants to react. Then on Thursday, we're going to get initial jobless claims. Now, usually this would be important. We're going to get the third reading, though, of GDP. And unless it's really different than what we've seen before, this will probably be more of a non-event. And we're also going to get the LEI, the leading economic index. Then on Friday is going to be personal income and spending, and the big one is going to be core PCE as well as consumer sentiment. And here's a look. And I have Tuesday's kind of the big day for what's going to be happening in the market. Seasonally, we are positive over the last 21 years for December 16th with the Dow, S&P, and NASDAQ. We're going to be entering into options expiration week, and that tends to be pretty positive. We're up 67% of the time and down 33% of the time. And now we're finally coming out of this more negative short-term seasonality, and we could potentially be getting into more positive seasonality, especially the further that we go through December. Monday is a pretty positive day, and it was in 2023. It's also a positive day in 2024. This is another newer chart where once we hit the midpoint of December, we tend to see positive seasonality going forward. This also shows that when we get into the next year, are we going to see things looking pretty good? This is the next 11 months going out, and this is just seeing how the market has been reacting since the election. And then this is 1 year from the election date. and this goes back to 1960. So at least we look pretty good based on this chart going into 2025. And now we're coming out of the weaker time, according to Tom Bowley's research, and now going back into the more positive time of December. And then this came out of the Stock Traders Almanac book. Right about here in the middle part of December is when we start to see what's called the January effect. And this is when small caps tend to perform well. This is from 1979 to 2023. And this can carry through all the way up until March or so. And we're wondering if that's going to happen. Now, we got faked out a lot in 2024. Small caps would zip up and pull back, zip up and pull back. Are we going to see more of a sustained up move this time? So look at the warning signs. We are looking more negative with our three smart money indicators. The advanced decline lines are showing some weakness, and we're still going up with the 5 and 10-day equity put call ratio charts. We're still going down with the S&P NYSE, McClellan oscillators, and summation indexes. We're still seeing some more weakness coming into our oscillators, and the Copic curve is turning negative. And the bullish percent indexes for the S&P and NYSE are continuing to go down. We have a non-confirmed Hindenburg omen. And the parabolic SAR is negative, the Swenlin trading oscillator is negative, and the 20, and now we've added the 50-period moving average study to the negative side. And on the positive side, the Vortex, even though it's showing a lot of weakness, it's still positive. And this is a more encouraging area. Growth to value and discretionary to staples. They're doing okay. They're at least holding up. And we're still positive, even though we're declining with the 100 and 200 period moving average studies. The bullish percent index for the NASDAQ 100, it's coming down, but it's right at that 70 level, which is the line for being extreme positive. The ease of movement, the money flow, the ultimate oscillator should be on the other slide. That actually turned negative. And the momentum for the NASDAQ 100 is still positive. And the financial sector, it's positive, but it's declining now and coming back to its 50-day moving average. And then the Hindenburg omen here. It'd be nice if we either get a confirmation spike or the 19th comes and this could go away. Perma bears love this thing, and they treat this one spike as though it's a done deal, and they're getting all excited about the weakness that we've been seeing lately, just sure it's going to lead to more, which could end up being more positive for the market because these guys are wrong almost all the time. All right, so our conclusion, we are positive. We're coming back into positive seasonality. We're still seeing this weakness under the surface, but for right now, large caps and growth are holding up. In the short term, it still looks like we've been just pulling back, and we're going through a period of weak seasonality. In the intermediate term, this is where the weakness has been developing, but we're still positive there. And even though we're coming down a little bit with our longer term moving averages, we're still positive in the long term. Thank you. I hope you have a wonderful weekend, and I will talk to you in the next video.